Different types of mutual funds. Mutual funds have grown in popularity in recent years as a viable investment option. They are a great investment opportunity for both new and experienced investors. In India, you can choose from a variety of mutual funds based on your risk tolerance, investment goals, and investment needs. Mutual funds provide innate diversification because they consolidate the funds of multiple investors and invest in a diverse portfolio of assets. It also has a slightly lower investment risk when compared to direct investments. Different types of mutual funds. Mutual funds are classified into 4 types based on the asset class that they invest in: equity funds, fixed income funds, money market funds, hybrid funds. Let's take a closer look at each category. Equity funds. Equity funds are a type of mutual fund that primarily invests in the stocks of various companies. These funds, while posing a high level of market risk, have the potential for high returns. While the general theme of equity funds is consistent throughout, not all of them are similar or comparable. While some equity funds may choose to invest in a single or multiple sectors, others may attempt to replicate an index such as the Nifty 50. Fixed income funds. Fixed income funds, also known as bond funds, invest a large portion of their investors' money in bonds issued by corporations and the government. Fixed income funds, as opposed to equity funds, seek to provide investors with a consistent stream of income rather than capital appreciation through share price growth. Also, fixed income funds do not have the same return-generating potential as equity funds. However, fixed income funds are far more secure than equity funds. Investors try to include these funds in their portfolios alongside equity funds due to their relatively safer nature and ability to provide consistent income. Money market funds. Although they sound similar to fixed income bonds, money market funds are different altogether. These funds typically only invest in highly rated, short-term government securities such as certificates of deposit, T-bills, short-term bonds, and dated securities. Since these funds primarily invest in government securities, they are the least risky of the 4 types of mutual funds. Money market funds are an excellent choice for risk-averse investors seeking a consistent return on their investments. Hybrid funds. Hybrid funds, also known as balanced funds, invest the pooled money in both stocks and debt securities. The fund manager determines the investment ratio in both stocks and debt securities, which can be fixed or variable. Typically, hybrid fund managers prefer a 60-40 split of stocks and debt securities. Given the wide range of mutual fund options and types, it's easy to see why they've grown in popularity in recent years. A great way to approach mutual fund investments is to build a diversified portfolio that diversifies your risks and maximizes your portfolio's potential for returns. Always read the mutual fund documentation thoroughly before investing in it to ensure that it meets your needs and requirements. Check out this space for more such educational videos from Accordions Business Services.